Welcome to Financial Repression Authority's Roundtable Insight, where the best fund managers, economists, and industry leaders discuss the key investment issues and challenges in the current macroeconomic environment.
Hi, welcome to FRA's Roundtable Insight. Today we have Ira Harris, Peter Boockvar, and a new guest, Jim Bianco. Jim is president and macro strategist at Bianco Research. Since 1990, Jim's commentaries have offered a unique perspective on the global economy and financial markets. Jim's wide-ranging commentaries have addressed monetary policy, the intersection of markets and politics, the role of government in the economy, fund flows, and positioning in financial markets. He's a chartered market technician, CMT, and a member of the Market Technicians Association. Ira is an independent trader, successful hedge fund manager, global macro consultant, trading foreign currencies, bonds, commodities, and equities for over 40 years. He was also a CME director from 1997 to 2003. And Peter is the chief investment officer for the Bleakley Financial Group and Advisory. He has a newsletter product called the Book Report, spelled BOOCKREPORT.com, one word. It offers great macroeconomic insight and perspective with lots of updates on economic indicators. Welcome, gentlemen.
Thank you.
Hey, Rich.
Thank you, Richard.
Great. I thought we'd begin with a discussion on volatility. We did a podcast recently with Chris Whalen about a week before the volatility began in the financial markets this year, volatility to a significant extent. And just wondering what the thoughts are on that. Jim, have you been seeing that as a trend through your research, or what are your thoughts on that?
Yeah, not as a trend, but pretty much the opposite. Volatility events like what we've seen over the last couple of weeks are not the creation of a trend. They are the exaggeration of a trend. So there was a trend in place already, and that trend in place was a turn towards more volatility. And that turn towards more volatility, I think, was driven by a belief that for the first time in the post-crisis era, inflation was returning. To get technical on you for 15 seconds, what basically I think happened with the volatility event is we caught a bunch of short vol traders on the wrong side of the trade. When they covered, they did one simple, narrow thing. They blew up the VIX market, the volatility measure on the S&P 500 index option. That's all they blew up. And when we found that that spiked from 12.5 to 50 in 2 days, we found out how important the VIX is to everybody else. It was their measure of risk. And when they saw it go up 400% in 2 days, they all reacted, and the next thing you knew, the Dow was down 1,600 points. But what I want to emphasize is they didn't create the trend. The trend is towards higher inflation, and that higher inflation will breed more volatility, and they got caught on the wrong side of it. All derivative debacles like this are just an exaggeration of a new trend that everybody got caught on, not the creation of it. The event didn't create it, it just underscores it.
And Ira, your thoughts on that?
You can't say it better. I'm just going to hang up and go away. So
okay.
I think that's perfect. So I'll let Peter speak to it.
So I think what exposed this, in 2017, we saw a pickup in at least in the U.S., the Fed decided, let's raise 3 times instead of 1. Let's start shrinking our balance sheet. And that was, of course, overwhelmed by the Bank of Japan and the ECB and tax reform. And I think in early 2018, when rates continued to rise, when the inflation pressure started to become more evident, it started to become more obvious that, wow, this is not just a short-term blip. Maybe this is the beginning of a more normalized interest rate trend. And one of the analogies that I've given in the past is that when central banks are full-on easing, it puts beer goggles on investors and makes everything look perfect. But when that starts to change and that liquidity flow starts to slow and rates start to move, then those goggles start to clear up a little bit. And I think that once we got past tax reform, that was really the last foundational bull case, and then monetary policy became more important. So markets are very reactive nowadays. And yeah, it seemed like 270 in the 10-year yield all of a sudden woke people up and said, uh-oh, this is a big deal. This is twice the level it was during the summer of 2016. I better start reassessing my positioning. I better start reassessing my leverage. I better start reassessing what valuation I want to place on the S&P 500. And the VIX and risk parity and all these other peripheral things became the symptom of what I call now the disease of rising inflation and rising interest rates that then caused this explosion in volatility.
Richard, can I underscore what Peter just said?
Sure.
There's been an argument in the marketplace that, yeah, inflation is rising, but so what? Higher interest rates are not a bad thing. They kind of take the idea that when it comes to inflation, it's either it's Zimbabwe and it's really bad, or it doesn't matter. But there's a middle ground in there, which I think Peter hit on, which is critically important. First of all, one of my crusades of the last few months is I've been saying to people, stop talking about the Fed. Stop about the Fed. Talk about central banks, because central banks as a collective are the easiest they've ever been in the post-crisis era this week. That their balance sheets are the highest they've ever been in the post-crisis era this week, the collective of them. If inflation returns, it puts into jeopardy the word gradual. Bernanke famously did a piece where he said, look, we're going to get the balance sheet back to $2.5 trillion, and it could take till 2026. He wrote it in 2016, 10 years. Oh, okay, we're going to take 8 or 10 years to get that. Well, if we have inflation, maybe your 8 or 10 years is now 2 years. And maybe now by the end of the year, you're going to have a contraction out of the ECB and the BOJ. That's where inflation matters. It's going to force central banks to pull in a lot faster than people thought. One last thing, Wall Street runs into this trap all the time. Somebody points out a risk. Everybody looks at their watch and says, well, we've waited 8 minutes, the market hasn't blown up, so I guess that risk doesn't matter. Well, for 9 years, people have been saying, look, there's a risk about all this money printing. Well, I keep looking at my watch, market hasn't blown up, you don't know what you're talking about. Well, here, for the first time in 9 years, we have an inflation fear, and it's now putting doubt in this forever largesse out of central banks. And what's the first thing the markets do? They have a conniption over that. So I think that this inflation fear that everybody says, bring it on, 325 is really good in interest rates. Be careful what you wish for, because that is going to force a reversal, especially out of the ECB and the BOJ, if we continue to see global inflation fears rise. The Fed's already tightening right now. That's why I said don't talk about the Fed, talk about central banks. And this could be a big deal for markets in 2018, and most people continue to dismiss it.
And just to add on, with respect to what you said, Jim, about balance sheets being at record highs, the analogy I like to give now is, yes, they're at record highs, but picture the balloon with the air being central bank easing going into that balloon. There's still air going into that balloon, but there's less air going in. And if there's less air going into that balloon is still going to contract. So I think it's the rate of change that is really changing dramatically in terms of central bank largesse that is causing also a rethink.
Could the return of inflation force all central banks to accelerate their exit strategy, or just some?
Yeah, go ahead, Ira.
I think to answer that question, Richard, you have to look at Kuroda was just reappointed with a very dovish group around him, because supposedly Abe, nobody gets reappointed for a second term at the BOJ. Abe appointed him, even though he was nervous about his Kuroda's stance on fiscal policy and his views on the tax, on the sales tax especially. But he's surrounded by a group that is very dovish. Draghi has dug himself into a hole. I don't know how he gets out. And Peter and I were just talking, but there was a piece from Project Syndicate yesterday by Jürgen Stark who is no lightweight. He's in the camp of like Otmar Issing, warning about the dereliction of duty of the ECB and that they've extended this into dangerous places. And how do you get out of this? So, Peter and Jim are both right. This is forget about the Fed. Everybody followed the Bernanke book, but they're stuck in a situation here, to me, that's really dangerous.
One quick thing about the ECB, Draghi's term has a little bit more than a year to go before he's done. And the tradition in the ECB is that the next ECB chairman will probably be a German. Doesn't have to be a German, but probably will be a German. And that's code word for a very, very hard money person. So if you're going to answer your question, if you're going to get inflation and you're going to get a German to run the ECB, you're going to get a violent reversal out of the ECB's policy in the next 18 months. And I think that that's kind of what's coming to fruition or thought in the market. And look at 2 weeks ago. The second day, 2 Thursdays ago, when the Dow was down 1,000 points, what was the catalyst story that everybody said? Carney came out and said, there's inflation in the UK, and that the BOE, the Bank of England, might have to double the rate of rate hikes that they're going with. And the Dow fell hundreds of points on that story. At least that's the articles that we read about it. When was the last time the BOE had moved the United States stock market? That might have been the first time. It's all because of this idea that central bank largesse is maybe peaking soon and starting to reverse. We haven't had to deal with that possibility until the last 2 or 3 months, because only in the last 2 or 3 months have we really started to see inflation fears really come to fall in the marketplace. Now, what Ira said is right, that maybe Japan continues, pumping up money and printing because they're going to be very dovish under Kuroda 2.0, but they might not be enough to do it. If everybody else is going to reverse, then those global central bank balance sheets will peak and start down. And I think that markets are going to have a digestion problem with that.
And just to add on to what Jim said, even the Riksbank in Sweden, which is obviously not necessarily relevant for the global economy, but because they experimented with negative interest rates along with some others, it's a good symbolic gesture. They said they're going to start the process of getting out of negative interest rates this summer, well before the ECB starts. I mean, we still think that there's, and correct me if I'm wrong, 8 to 9 trillion of negative yielding paper that just going back to zero from negative is going to cost an extraordinary amount of loss. And what the ripple effect that's going to have throughout yield curves around the world, I don't think people fully appreciate. And I like to remind people in terms of the concept of risk happening fast. It was 2015 when the German 10-year went from 6 basis points to 60 in 1 month, and then went from 60 to 100 basis points a month later. And this is Germany. This is not Greece. This is not some third world country. This is Germany's 10-year went from 6 to 100 basis points in just 2 months. So it can happen again.
Mm-hmm. And so how would all of this, or how could all of this translate into a change in the basic relationship between stocks and bonds? Jim, you mentioned there would be likely a change on that once again.
Yeah. First of all, just as a point of emphasis, one of the things that could change it back the other way is if this bout of inflationary fears goes away. And that, we had kind of a very mild form of inflation fears about a year ago compared to now, and then it went away. But the difference between now and a year ago is we're actually finding out that the Fed is, not the Fed, but the market is collectively a bunch of Phillips curvers, because they're looking at stimulus through tax cuts. They're looking at possibility of infrastructure spending. They're looking at strong growth, and they're concluding that we're going to have inflation. After we've spent 30 years trying to say the Phillips curve, that growth does not create inflation, that's where the market is. So the market makes its own reality. If it's decided there's inflation, there's inflation. But that's where it's coming from. But to your question about the stock bond relationship, it changes all the time between the way that stocks and bonds trade together. In 1998 to 2000, it changed. It used to trade what I used to call under an inflation mindset. From the 1960s to 2000, the starting point of every discussion, I think, was, are we having inflation? And if the answer was yes, interest rates went up or bond prices went down and stock prices went down. If the answer was no, the 80s and 90s, we're not having inflation, then bond prices went up, interest rates went down, and stock prices went up. So bond prices, stock prices moved together. Starting around 98 to 2000, we switched that dynamic to we worried about deflation. And during the middle of that dynamic, we had all kinds of stress points. We had long-term capital, the Russian debt moratorium, the Asian financial crisis, the tech bubble, because everybody had their models of how the world worked, and it stopped working. Sound a little bit like the derivative thing we've seen in the last few weeks as well. Now I think, and so throughout the 2000s until very recently, we worried about deflation. Every question started with, are we having deflation? If the answer was yes, interest rates plummeted, as Peter pointed out, to negative in Europe, and equity prices struggled. If we were relieved there was no deflation, then interest rates went up and equity prices went up. So it's, bond and stock prices traded opposite each other. What we've seen in the last 3 weeks is the biggest decline of stock prices and bond prices together since the financial crisis, that they both went down together. We're at a 291 10-year note on a day when the Dow was off 300 points. Up until 60 days ago, if you just randomly told me over the last 9 years, Dow's down 300 points, I would have said, we got a 8 or 10 basis point drop in the 10-year yield. That's the way we traded every single time, except for the last 60 days, because I think we're shifting to a inflation mindset. Now, where does that matter? Last thought for you here. The last 9 years, Wall Street has pushed this idea of a 60-40 portfolio, that this is the optimum way to invest your money. 60% in equities, 40% in bonds, because something is always going up. Either there's no deflation and stocks are going up, or there's deflation and bonds are going up. But under the new scenario, either they're all going up or they're all going down. And what's been happening is both of them have been falling together. Stock and bond prices have been falling together. So this idea that you can take a lot of risk with a 60-40 portfolio, I think, is going to be blown up in everybody's face, because that relationship between stocks and bonds, I think, is transitioning right now. 98 to 2000, it took 2 years to fully transition it. I don't know if it'll take fully 2 years now, but it will take at least months to do it. There'll be periods where it doesn't look like it's transitioning, but I do think we've started that process.
And Ira, do you see that relationship also changing?
Yeah, and Jim, and I know Peter's written about this too, this whole risk parity, which all weather, the AQR, they've all run these big programs.
Yeah.
And to me, what people don't understand, especially on the issue of how do you get out of this? Because, we could talk about Ray Dalio, and Ray Dalio just did a 180 from when he was in Davos, telling people that you're going to shed tears if you're in cash,
yeah, to
talking about a coming change. Now that's in a 2-week time period. It scared the hell out of me because, well, wait a minute, he's one of the, and he is, Ray Dalio is a great thinker. I've watched him for over 35 years.
Just to emphasize one thing that Ira said real quick about that is that the single hardest thing to do, anybody in investing, is to recognize a regime change, that the old rules stopped working. Most people can't, and they keep pounding away with the old rules until they're basically out of business. But to me, it sounds like what Dalio did is say, look, all the PhDs and all the old models that you had, that you've run every tick since 2009, and you know how the relationship works, throw it all away, because we're now in a new environment. And that's really hard. That's the single hardest thing to do in any type of investing, is to say, we're now at a regime shift. Because if you're wrong, you get wiped out. if it isn't a regime shift and you say it is, you get wiped out. If it is a regime shift and you don't adapt, you get wiped out. It's the most precarious time. That's why we have all this volatility and a lot of blow-ups along the way.
That's right. And what I think what people fail to understand, especially people who come on and talk about it, who really don't understand how the risk parity works, it's not just Dalio's position. It's everybody who handles his book who's tail-coded him. Just like in 1992, I know a lot of people at banks, foreign exchange traders, who made a fortune tail-coding George Soros on breaking the Bank of England. Well, if the Bank of England had reacted like the Bank of France and raised interest rates to 100% and said, we're just going to do whatever we have to do and you're going to pay the cost of it overnight, and he wasn't successful in breaking the pound to the D-mark, well, to exit that trade would have been an enormous pain because of all the people who followed him in. So whatever you think Dalio's positions are, which I think are enormous, it's the amount of people who've tail-coded and synthetically recreated the same trade, in many other ways. And I think that's what we saw over the last 2 weeks, is that he's got a lot of company on these low volatility plays.
And Peter, your thoughts also?
Yeah, I also think what's going on is a lot of people have lost perspective on the markets. Like if you turn on the TV, the radio, you read the paper, people say, well, earnings are great and the economy is great, therefore stocks are going to go up. And I just want to point out that from the end of 2012, so calendar year beginning 2013, to the January 26th peak in the S&P 500 was up 100%. Earnings since then, assuming 2018, assuming $150, $155 a share, which is the current estimate, so you take 2013 to 2018, earnings are expected to be up 60%. So the difference is obviously multiple expansion. So when interest rates start to rise, when people reassess what central banks are doing, well, why should people pay 18 times earnings? Well, all of a sudden, within a week and a half, they decided let's pay 16 times with not $1 change to earnings per share. Well, every one turn in PE is 155 points. Well, 2 PE, you're talking 310 points just on a multiple rethink. And so I think people need to have perspective that the stock market has run well ahead of the rise in earnings. And the difference is PE multiple expansion that is now compressing because this new regime change that we're talking about.
Now, could rising interest rates in the U.S. cause a strengthening in the dollar, spurring rising defaults in U.S. dollar-denominated debt in emerging markets, estimated at perhaps $9 trillion? So could that happen? And could it also spur a financial crisis in Europe out of the bond markets? And would that mean international capital flows coming to the U.S. Towards U.S. dollar-denominated assets? Just some thoughts and potential scenarios. Jim, your thoughts?
I would probably come down on the idea of no, and let me explain what I mean by no. There's this perception in markets that there's all this money that there is no, to use an old adage we like on Wall Street, there is no money heaven. Is that, that no one ever loses money. It just gets reallocated around. The stock market will go down, but all the money from the bond market will come in to replace the stock market money that went down, and the markets will be fine. I don't think that you're going to see some kind of a reallocation where, everybody's going to go running into the United States, and it's going to buoy the U.S. stock market, and it's going to hurt them as well, too. I think the problem with the dollar, and I've been wrong on the dollar now for several months, is that the speculative flows some of them are at record levels right now. Everybody's selling the dollar. Everybody's shorting the dollar right now in a big way, and it's been keeping it unnaturally strong. If you wanted me to guess, why are we getting such persistent selling of the dollar? It's because foreigners are basing their investments on who the president of the United States is. Sell the dollar, sell the dollar, sell the dollar, where domestic investors have finally realized it doesn't matter. And I think that eventually that's going to come back to foreigners and go, you know what? It doesn't matter. And that you're basing your belief on a political or your investments on a political ideology as opposed to on investments. And you might see some strengthening of the dollar, but are you going to see some kind of a wholesale run into the dollar that you were suggesting? No, I don't necessarily think we're going to see that.
Ira, your thoughts?
Having been bearish the dollar since Mark Field's comments back in 2017, so now I'm fairly neutral towards it because, again, it's been it's a quandary for people because interest rates in the United States are going up, and fiscal stimulus is there, which has always been combined together, are usually a positive for a currency, and it hasn't happened this time. So I'm not sure why. I'm scratching my head, and I've come to basically, I think I'm more in Peter's camp now, which is that the deficit scare is real. I think that what they did here by blowing the budget apart, and they did blow the budget apart with the removal of the sequestration caps and the stimulus. I think people are a little bit nervous. Now what's the level? I don't disagree with Jim because I'm really neutral the dollar here. Where will this change? Well, I think that if on the short rates, if we go to real yields, and I know Peter wrote about it today, so if you go to real yields that are at least positive on the short end of the paper, right now I'd say they're still negative about 40 basis points based on the best inflation numbers that we have. But if we were to go positive, I think the dollar would get a kick, especially if the other central banks are just sitting there complacently because they would like their currencies to weaken anyway. I think Mario Draghi would like the euro to weaken. I think Japanese policy is driven by the desire for a weaker yen, but they're a little bit nervous with the Trump trade agenda. So people are being cautious here, but I think underneath they would like to see the dollar strengthen relative to their own currencies. So I'm in a wait and see mode here. I don't really have a good sense where we go from here.
And Peter, your thoughts?
Yeah, I mean, I'm secularly bearish on the dollar, but in the short term, considering the move it's had, I'm definitely more uncertain about the very short-term move. I mean, I think that there's been a rethink. So we went into the year, Fed is saying they want to raise 3 times. The market obviously doubted it. And now we have the rise in inflation that is probably happening quicker than some thought, including probably Fed members. And higher inflation that's not met by a rising Fed funds rate is typically dollar bearish. I mean, the Fed's going to raise 3 times this year and only take the Fed funds rate to a real rate of 0. Now, that, of course, is well above where it is overseas, particularly in Europe and Japan. But I think there's a reality that Jay Powell, people still think is Janet Yellen 2.0, even though maybe he's not. But I think he's still going to be on this gradual path. So there's no way the Fed's getting ahead of the curve. They're still going to be playing catch up. On top of better overseas economies, that's drawing dollars into other areas of the world, and whether it's China's desire to create an oil-based yuan product. I mean, there's secular headwinds to the dollar, but again, in the very short term, I'm less certain. I was very certain when the euro was 105, but much less certain when the euro is 125 in the short term. I still think I would not be surprised over the next 2 years. We saw euro 140. That would not surprise me at all. If we saw pound 160, I think that's where we're eventually heading, to be honest, over the next couple of years.
And Jim, you mentioned this whole environment could be like the 1980s and 1990s when markets went down, everything else went down. Where do investors and traders go to in this type of environment, generically speaking, no specific mention of companies?
Oh, well, I mean, that's always, that's the old 60-40 risk on, risk off mentality. Something's always going up. Yeah, I guess, somebody's going to win the lottery today too. But But I think that's going to be the single hardest thing, is that if the answer is there going to be an asset class that's going to be rising, the answer is they're going to be small. Commodities might be rising, but 95% of the money in the world is not in commodities. Maybe we're creating a new asset class, cryptocurrencies, that I personally think is an outgrowth of the rejection of 9 years of central bank policy. That might be a place to go. But if is inflation, it pressures financial markets. They go down. Stocks go down, bonds go down. That was, ask Ira, that was the 1970s. Now, I'm not saying we're going to have a high level of inflation, but what we are going to have is a removal of central bank stimulus that's going to give you the appearance of a high level of inflation. So I think it's going to be very hard to find, other than special situations, like maybe in the commodities markets. But again, most pension funds, most endowments, most trusts, most institutional managers have no allocation to that. And so beyond that, I think it's going to be very hard to find ideas where you can profit if we're returning to an inflationary environment.
And Ira, your thoughts?
Well, I agree with you. And you know what we're really looking at here, and what we're saying is that what we're going to see is a feedback loop. Well, that's a term we haven't heard in a while. A feedback loop developed. Let's say that the inflation does return, and let's say that the Phillips curve authorities maybe get it right for a short period of time. So higher wages beget higher interest rates, and now that feedback loop is absolutely destructive of what Jim talks about as that 60-40, because they are both going to go down. And I'm not a Phillips curve advocate, but if inflation does that, and those are both detrimental to corporate profits, because rising wages with rising interest rates to combat it are all coming out of the bottom line. So these people are talking about where profits are going to be 6 months out or 9 months out. I just don't see it. Because they've got, how much, and I know Peter's looked at this, so he'll speak to it, but over the years, how much has cheap money fallen to the bottom line of all these companies who borrowed a lot of money, but their borrowing costs are way down, just like the United States government. We look at, take the interest rate expense on the budget item, and it's down to very low levels. Well, we know that's not going to last, because for every 1% rise in the cost of borrowing, it's going to hit discretionary spending levels dramatically. People are in for a shock here. This budget, and it's really fascinating that Gary Cohn is absolutely at odds with what Goldman. I wonder if they're talking to each other anymore, because Goldman came out with a scathing piece over the weekend, and Gary Cohn's response to the budget was, it really doesn't make any difference. We're much more worried about deflation. We know how to deal with inflation. I mean, it was in the piece, in the interview that he did. So you're going to get into a feedback loop here. I think Jim is dead right. At 60-40, they're going to be sorry. And yes, I'm old enough to know in the 70s, thank you, Jim, that they both go the same way.
Okay. And Peter.
Well, just to quantify what Ira said in terms of profit margins, lower labor costs and lower interest expense were the two biggest contributors to corporate profit growth from the 2009 bottom. And just to quantify, there's about $13.5 trillion of total business debt. So every 100 basis points of interest cost is $135 billion. Now, obviously, a lot of companies have termed out debt, but just generically speaking. And then in terms of labor costs, companies pay about $7 trillion of labor costs every year. So 1% change, that's $70 billion. So let's just combine that. That's over $200 billion of higher costs. That more than offsets the cut in the corporate tax rate from 35% to 21%. So a lot of the estimates that are out there for earnings per share are all else equal analysis. It doesn't take into account higher interest costs. It doesn't take into account higher labor costs. And when a lot of sell-side analysts come out with their year-end price targets, it doesn't include a lower PE ratio. It's a very static analysis. Now, in terms of where to survive here, I would not be surprised if a 2-year T-bill paying 2.25% interest rate outperforms the equity market in a broad basket of corporate credit over the next 2 years. I also liken to what Jim said. I think the commodity space is very interesting. I know a lot of people like to look at the demand side in terms of dictating prices, but since that 2011-2012 peak in commodities, particularly industrial metals, the mining capex has collapsed. So I would be looking at not only industrial metals, but also energy and particularly agriculture, which I've been very bullish on. And on my belief on the dollar, I think gold and silver will outperform most equities and certainly fixed income over the next couple of years.
Just to put a geek, let me put a geek point on what Peter was saying. There's $13 trillion worth of debt, and most of it has been termed out, meaning, rates go up now, but I've got 3 or 4 or 5 or 10 years to maturity, so I don't have a reinvestment risk immediately. The last 10 years or so, there's been a lot of people that have been terming out their debt through the derivatives markets. They've been engaged in floating or fixed payments or receiving in order to take shorter-term debt and term it out into longer-term debt. That's fine, except when you get a spike in volatility. Now it's going to cost you a lot more to term that out than it did just 2 weeks ago. So even that's going to start to come back to this spike in volatility. Well, I've got all this short-term debt. The Fed's going to raise rates. What do I do? You engage in a swaps contract in order to make it mimic a 5-year note or a 10-year note. But now it's more expensive to buy that swap contract because volatility is going up. So even that's going to start to hit their bottom line as well, too.
Well, great. Thank you very much, gentlemen, for your great insights. And just wondering, how can our listeners learn more about your work? We'll go around. Jim?
Probably the easiest way is to follow us on Twitter at BiancoResearch.com or at Bianco Research, or our website, BiancoResearch.com.
And Ira?
At iraharris.com, and the blog is Notes from Underground. And when I'm busy and life is right, I write 3 or 4 days a week about many of the themes we talk about, and we go from there, and it'll at least give you some food for thought.
Yep. And Peter?
My Twitter handle is pBoockvar, and then you can see subscribe to my daily writings at bookreport.com, and the money management business is bleakly.com.
Excellent. Great. Thank you very much, gentlemen.
The FRA Roundtable Insight Show is for informational and educational purposes only and should not be considered as a solicitation or offer to purchase or sell any securities. The investments, investment strategies, and investment philosophies discussed or presented on the show each involve their own unique risk factors which are not discussed on the show. Any discussions among the panel participants or responses to listener inquiries are based on the personal opinions